Well, hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of the Big C. I'm Nigel, and I'm back with your daily dose of commodities, cryptos, and currency. Well, today we'll center focus on cryptocurrencies with Bitcoin layers Nick Bhatia. We'll also discuss crude and the way forward for prices. Carole Nakhle of Crystol Energy will be joining in as well. So we're looking forward to speaking with Nick as well as Carole. But before we get to this conversation, let's take a quick check on how global equity markets, well, they are shaping up. Wall Street closed, remember, closed on a solid note actually. Good earnings beat came in from Alphabet. That was heartening to see. While you have Tesla and IBM on the flip side, well, they're lower on the back of the revenue disappointment in Q2. The S&P 500 overnight notched its 12th record close of the year. The Dow Jones closed with over 500-point gain and just a few 4 points away from its fresh peak. Meanwhile, the tech-heavy Nasdaq posted a close above the 21,000 levels for the first time. Asian markets this morning, though, they're trading a little bit mixed, actually. The street continues to focus on the trade developments between the United States and Japan, as well as any kind of positive signs for a deal with the European Union. That's what spurred investor optimism overnight that hopefully we'll see a more rational President Trump. But a quick check on the oil and the currency markets then. Crude oil prices, well, they paid some earlier losses on the back of a sharper than expected decline in US crude inventories last week. And optimism over trade deals, well, that's what's fueling a move and a recovery from the day's low. However, uncertainty over the US and China deal and a truce between Russia and Ukraine, that's what's capping any kind of further gains. The mood, though, continues to be buoyant in the forex markets as well. Both the yen and the euro, well, they're holding on to steady gains in anticipation of more trade deals. The street will also be eyeing the ECB rate decision due later today. The yuan, meanwhile, scaled a 8-month high after the PBOC guided the currency strength, setting a firm midpoint range. The move comes days ahead of the new round of trade talks between the United States and China. Well, a trade deal talks are underway between the United States as well as other countries. The United States and European officials, they signaled progress in tariff talks. The US president also touted a recent deal between the United States and NATO, whereby European allies would purchase weapons and send them to Ukraine as it fights Russia. Let's listen in to that soundbite.
Just made a deal with the European Union where they're going to pay the United States of America 100% of the cost of all military equipment. They're going to ship it to the European Union, and then they'll distribute it, and much of it will go to Ukraine. It's been a long time since you've heard those words, because we're in for $350 billion. But now we send it to Europe, and Europe pays, and we're in the process of completing our deal with China. And as you know, the UK, we made a deal. It was a very good deal for everybody. Everybody's happy. It's always nice when everybody can be happy. But mostly we'll be charging straight tariffs to most of the rest of the world, because we have over 200 countries. People don't realize that's a lot of deals. Even if you're like me, a deal junkie, that's a lot of deals. That would be too much for anybody. Ooh. And we're making deals with various Asian countries that need it. And it's actually hard to believe, you don't think of it, but Asia is very close to Alaska, relatively speaking. It's not the closest, but it is pretty much the closest when it comes to oil and gas and energy. And we're making some incredible deals. The opening up of a country is very important to us. We have numerous countries that have opened their doors, just made some incredible transactions, but we're going to have a very, very simple tariff for some of the countries. There's so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple of we have 15 because we haven't been getting along with those countries too well, so we just say, let's pay 50, and that's the way it is. But remember, we get countries that were closed, always closed. Everyone in this room would never remember any of them to be open. We've offered such a deal to the European Union, where we're in serious negotiations. And if they agree to open up the union to American businesses, then we will let them pay a lower tariff.
Interesting. On a day-to-day basis, you hear something or the other coming in from President Trump. But as promised, let's get straight to our cryptos discussion. And to help us out with that discussion, we're joined by Nick Bhatia, founder, the Bitcoin Layer, who joins in on the show. Hi, Nick. Good to see you in. Thanks a lot for joining in on CNBC TV18 Prime. Well, you're highlighting in a couple of your notes a couple of factors, actually, which are working in favor of the Bitcoin, like the scarcity premium that it's getting. And it also will not be impacted on that fear. You know, everyone's talking about the fear of elevated debt in the United States. Well, the Bitcoin could basically be charting a trajectory of its own and not too concerned about the big US debt pile. Run us through both those 2 points.
Well, on the second point, the United States has a $37 trillion debt pile. And now, as the United States continues to expand its debt, that fuels credit expansion throughout the system. And credit expansion is one of the most important underlying fundamentals to Bitcoin and Bitcoin's trajectory. As the number of dollars worldwide continues to grow, the understanding of Bitcoin as a scarce commodity in the backdrop of those dollars continues to shine. And we really see that taking fold not only over the last few years since the global pandemic of 2020 and the subsequent money printing and credit creation from across the world's central banks, but for many years before the pandemic. Bitcoin is now 16 years old. So what I believe is that Bitcoin is responding to that never ending expansion of credit.
Interesting times. Yeah, as you're mentioning as well, you know, global credit growth spikes, that's actually good news for the Bitcoin. But run us through the correlation with the dollar. Now, when the dollar weakens, then there's demand for the Bitcoin. But, you know, my question to you is, would global central banks be a little bit cautious of opening up their economies to cryptocurrencies? Since it could be actually a risk to their local currency. Just want to comment on that.
It's an interesting point. And in the United States and various countries around the world, they have different relationships with Bitcoin.
Yeah.
In the United States, for example, the country is taking a more pro Bitcoin stance because it believes that the private sector can benefit from participation in the Bitcoin network, whether it is in the investment arena or in mining directly, and that the growth of the economy due to Bitcoin activity can boost the nation and the nation's economic activity as a whole. In other countries, Bitcoin is not so popular with the government because if individuals within that nation choose Bitcoin over their local currency, it could, at the margin, weaken those systems. Why? Because if there's less demand for local currency deposits, then that by definition weakens the capital base of the banking system in that country. So you'll see a tale of two worlds: countries that are pro Bitcoin because they believe it can boost economic activity within the borders, and those that are scared of it because it can draw money out of the deposit system, as well as lower the demand for the local currency itself.
The US clearly believes that Bitcoin's good. And in Trump's regime, you know, there are calls that the Bitcoin could scale even higher. If you had to put a level to the Bitcoin, you know, it's at around ballpark 120,000 odd. By the end of Trump's term, where is it headed?
Well, our model at the Bitcoin layer suggests that Bitcoin can reach prices of $1 million or higher sometime in the next decade. And in the short term, it's very hard to predict Bitcoin's price, especially with historical volatility above most other asset classes in all of history, really. But The way that we think about it is that Bitcoin is achieving somewhere in the 30 to 50% range of compounding annual growth. And if you extend that over the next 5 to 10 years, you could easily see Bitcoin going from 6 figures to 7 figures. Over the lifetime of the current administration, much harder to predict because there are really only 3.5 years left there.
Oh my God. Nick, for the equity market participants, they would be thinking, what are they doing with equity? You're talking about 120,000 becoming, a million. And you're talking about 30 to 50% compounding. Wow, that's going to be something, if we get there. So tell us about the relation then. Normally you see when the Bitcoin moves, there is a bit of a correlation with global equity markets because it means risk on. But as the Bitcoin becomes more popular, do you think that correlation gets broken a little bit and then the crypto outperformance actually comes down? What's the correlation, say, between the US markets and the Bitcoin? Please go ahead.
It's a great question, Nigel. It's something that we think about a lot, and a lot of our readers are focused on this. They see the spot correlation between Bitcoin and the stock market, and they think, well, in the future, if Bitcoin becomes a much larger reserve asset, will it lose that risk on correlation with stocks? We believe not necessarily, that it will continue to display a strong correlation with equity markets. And why is that the case? It comes down to liquidity and credit creation. So in our model, we use a model of liquidity that measures the strength of the banking system and the strength of the collateral that underlie the banking system, which in the United States dollar system is US Treasuries. And as US Treasuries achieve stability, stable interest rates, and you mentioned the dollar, as long as the dollar is not strengthening too much, risk assets respond very well to this. So stocks and Bitcoin both, they benefit from credit creation. They benefit from supportive liquidity conditions. I don't see that changing in the next several years. Bitcoin will continue to respond to liquidity conditions just as the stock market will. So we see periods of extremely high correlation between these two assets. And then we see brief periods in which the correlation drops significantly. It's actually during these periods of low correlation that we see Bitcoin's price achieve the greatest returns. However, zooming out, we do see the relationship between stocks and Bitcoin continue to hold.
All right, Nick, but what does it mean in terms of the US dollar then? Trump kept saying he's going to be making America great again. And the world was looking at the United States with a lot of supremacy. That's why we had the dollar index that danced away from around ballpark 102, 103 to more than 110. And now it's cooled off. The dollar index is hovering in that vicinity of around 97. Yes, we have seen the euro strengthen. Yes, we have seen some strength in the pound as well as in the Japanese yen. But what's the trajectory on the dollar index from here on?
This is something that I'm thinking quite a bit about, the direction of the dollar. At the margin, I see the dollar continuing to weaken here. Technically, it's experiencing a bit of a breakdown below 100. Over the next few years, it could go much lower. When you mention making America great again, that political stance is heavily dependent on reindustrializing the US manufacturing base and the ability of the country to provide more goods to the rest of the world in relation to the amount currently that it is importing. In order to reinvigorate the US manufacturing base, a weaker US dollar is a necessary condition. So when you listen to Secretary Treasury Scott Bessent break down the policies, what he's saying is that a strong dollar isn't necessarily what the country wants versus its trading partners. What it wants is a strong dollar system and a strong ability for the country to create credit. That doesn't mean a strong DXY. It could actually lead to a weaker DXY. So we have to be able to read between the lines on what Make America Great Again really means. And I personally believe it means a slightly weaker dollar. Also, when you hear their opinions on how other countries should be coming to the negotiating table, yes, they want low barriers to entry for United States goods going into those countries, but they also want to prevent currency manipulation, which means the outright weakening of foreign currencies relative to the dollar. What does that mean? It means a weaker dollar going forward. So that's the path forward, I think, for the dollar, but very hard to try to get into the mind of the current administration.
Indeed, and you have Trump taking on Powell, so that's another entertaining piece, sitting far away from the United States, if I had to put it, put it lightly. Very quickly, before we let you go, it'll be interesting to see who comes in place of Powell. But in the near term, what are you penciling in terms of Fed action?
I think the Fed is biased to cut a little bit. Right now, we see the 2-year yield trade somewhat below 4%, with policy rates around 4 1/3. So that is a forward projection that the bias of Fed funds is slightly lower. But with the United States economy doing quite well right now, there isn't a rush to cut rates. So I think the market has a little bit of cuts projected into the fourth quarter, and I would agree with the market there. We might get one cut this year.
Nick, it's been good chatting with you. Looking forward to keeping in touch. The key highlight for me is the way you're expecting the Bitcoin to just compound. It's saying that acceptancy will just go up, and 120,000, maybe we could just be getting started if you're talking about $1 million on that particular asset. Thanks a lot for joining in and filling us in with your take on the Bitcoin, its relation to other asset classes as well. Well, time to slip into a short break. Up next, we'll be joined by our expert on crude. We'll have Carole Nakhle, who will be joining in. Welcome back. You're tuned in to the Big C, and let's move our attention from the cryptocurrency world to the commodity space. And our focus today is on crude. We have Carole Nakhle, CEO at Crystol Energy, who joins in. Hi, Carole. Thanks a lot for joining in. Well, we have seen a bit of a drawdown in U.S. inventories, and that's what seems to be supporting prices, at least as of now. Could you tell us, how do you see the demand-supply dynamics play out globally first? We had the OPEC Plus that went ahead and they cut a lot of production, and now gradually they seem to have bought most of it back. So how do you see the global supply dynamics play out?
First, let's a little bit break down the situation and look at market fundamentals, and I can cover a bit of OPEC strategy, bearing in mind the time that we have. But when I look at the market today, you're absolutely right that we are seeing the drawdown in US crude inventory, and that is supporting prices to a certain level. And this is expected at this time of the year because the driving season has become, the holiday season is here. Usually people travel more, they consume more oil products, and that should be supporting oil demand. But if we look at the bigger picture, at the longer term trend, I'm yet to see the strong growth in demand that many have expected it. Of course, tariffs and economic policies are weighing heavily on oil demand forecast, but it's more than that, because if I look at the main engine for growth demand in the world, it's coming from Asia, primarily from China. And there, long before the tariff, long before President Trump came to the White House, we were seeing structural problems that are unlikely to be resolved in a year or two and require some structural reforms. So when I look at that picture, I'm not really expecting a massive transformation in the demand outlook suddenly if there is a tariff deal, for instance. But we cannot underestimate the impact of the state of tariff negotiations on economic growth forecasts, which have been revised downwards. So that is on the demand side. On the supply side, again, let's let the prices guide us. And I'm not talking about day-to-day volatility. I'm talking about the trends. When we look at all the geopolitical developments that have been happening around the world, and including the more recent one, Iran-Israel attack, and still I see prices where they are at the levels we are seeing. It's just the market is telling me there is plenty of supply. And that supply, yes, is partly coming from OPEC Plus releasing some of their previously voluntary withheld barrels, but also it's also coming from outside OPEC Plus, particularly from the US, from the non-OPEC Plus countries led by the US, but also by countries such as Guyana, the new kid on the block, which suddenly became an important producer in a matter of a few years, as well as Brazil, Canada, and Norway. So overall, we are seeing a market which is balanced, comfortably supplied, and there is no such a panic. But mind you, we should always expect the unexpected. But the question is not whether we're going to have spikes. We should always expect them, but how long it will take the market to correct those spikes and going back to the territory of prices that we have been seeing for a while now in the last few years.
You know, Carole, in the past, we have seen when geopolitical issues have come to the fore, you've seen crude oil prices dance away. Now, this time around, even when there was that skirmish between Israel and Iran, you had crude oil prices that bounced all of $10 per barrel. And the decline was as swift as well. Do you think those days of $90, $100 per barrel are well behind us? Or do you think, there's still a possibility that in the coming, months or so, we could still scale those levels? Because underlying demand, as you're saying, is very, very weak. Even a disruption is not able to get Brent crude prices higher.
I like what you use the word skirmishes between Iran and Israel, because for market observers, especially for people sitting in the Middle East, it was much more serious than that, because it was something quite historical. We did not see that happening before. And you're absolutely right in the sense that, yes, there was a spike, but then the market corrected itself very quickly, and we saw this kind of rapid decline from where prices jumped to much lower levels quite quickly. Now, of course, there is a market fundamental analysis there, whereby there has not been any supply losses. So if we would have seen supply losses, we would have assessed different market conditions and would have seen how long were those losses going to last and how quickly they were going to be replaced. So I think the spike was not driven by structural changes in the market. They were driven by fear of potential escalations, and we could see that how the problem was resolved relatively swiftly without affecting neither existing production or the trade of oil, especially through the Straits of Hormuz. And even if there were attacks, and they're still going on in other places, such as in the Red Sea, already the market has adjusted to that because many tankers have diverted to using other routes. Now, does that mean that we should rule out entirely a three-digit oil prices? Look, first of all, I can say that there were many market analysts, who were still stuck with the 70s views of oil markets, whereby any tiny problem in the Middle East would have sent prices soaring. I don't subscribe to that, simply not because I don't believe in prices going up. They can always go up to that territory, but we should not overlook the very important change in oil market, that this is not the 70s or the 80s anymore. Oil is not as important to the global economy as it used to be 20, 30, 40 years ago. So there are these long-term trends that have been with us for a while, and we should avoid jumping to conclusions. That said, geopolitics, and let's define what geopolitics is, not just about countries attacking each other. For me, any government measure that messes up or meddles with market affairs, I would put it under geopolitics. And there, the list can be very long. But for example, if the US decides to apply secondary sanctions on Russian oil and impose more stringent application enforcement of the sanctions on Iran, and we end up seeing losses of barrels in the market, then we should always expect prices to jump. But the question is, again, not how much they are going to jump, but how long they are going to stay in that territory. And that is an important change in oil markets today.
US sanctions will be something that we keep an eye out on, and as I put it lightly, skirmishes across the globe, particularly with regard to the Strait of Hormuz. Carole, no one likes wars. Global economy aside, humanity first, and hopefully dialogue is the way ahead as well, even in the coming years. But Carole, before we let you go, we had crude oil prices that dipped drastically as well. Earlier on, when the fear was that global demand is just going to, get slammed because of these tariffs. At some point of time, even the OPEC Plus will say, hey, we're pushing too much of supply into the market. So what is the price point you think that they start pulling back yet again? And what would be the near-term base on crude oil prices? Give us a level, say, for the next 12 months or so.
Yeah, look, I mean, I have to be honest, nobody can predict oil prices. You are much better predicting the weather than we predict oil prices, but we look at market trends. Now, when I look at OPEC Plus, which is still a very important player in global oil markets, many questions come to mind, like in terms of why they are putting barrels in the market when prices are at the levels where they are today, and there's no demand booming, no losses of supply. And you can read it from different angles. And that's when you look at, you take in consideration all those potential explanations, then you understand that actually it was not a horrible strategy or a big mistake on the side of OPEC Plus. Primarily that maybe they came to believe that the current price environment, I don't want to call it low because it depends on the eyes of the beholder, right? So in the current oil price environment is going to stay with us much longer than previously expected. And then by them putting already barrels in the market, they did not crash the market, they did not crash prices. So prices stayed at those levels, and that kind of supported their strategy. But there could also be a third explanation, which is maybe at some point they are expecting not a rebound in demand, but maybe supply losses from elsewhere, and that would allow them to close the gap. And of course, there is always the fourth explanation, which is to punish the cheaters. And OPEC has a long history of non-compliant members, and they end up being subsidized by the other very important players within OPEC. And it's kind of time to readjust the balance and impose a stricter discipline. So when you look at all these factors combined, you understand why OPEC Plus is putting more barrels in the market. And now they are unlikely to change their strategy at the moment because the market has not changed drastically. But of course, if things change they become differently, then we should expect to see an alteration to what they are going to do next.
Carole, it's been a pleasure talking to you. Thanks a lot for joining in on the Big C. We look forward to your inputs in the time to come as well. Wishing you a good day ahead. Well, folks, we thank you for joining in on this episode of the Big C. Stay tuned. News and updates lined up on the other side.